Hopefully you watched my previous video on options. If not, check it out. It's not optional. In the last video, I covered the basics of options, calls and puts, where you buy options which give you the right to buy or sell stock. There are two ways you can use options to potentially generate income by selling options. First thing to know, a covered call strategy. This sounds complicated, but really it's just collecting money by selling someone the right to buy stock that you own at a price you'd be willing to sell within a certain time period. Let's say you buy 100 shares of Purple Pin Company at $90 per share, and you'd be willing to sell the stock and take the profit if it reached $100 per share. Instead of using your typical limit order to sell at $100 and hoping for it to someday trade there, you could consider selling a covered call to generate some income while potentially achieving the same result. If you sell a call option with a strike price of $100 that expires in 30 days for $1.50 per share, you're obligated to sell your stock at $100 if the price of the stock closes above $100 in 30 days, or if the owner chooses to exercise his right to buy for $100 earlier. Side note, a standard options contract is for 100 shares. So in this example, with the option at $1.50 a share, you'd get $150. Weird. If the stock goes above $100 and you sell your stock, great. That's what you want to do anyways. Plus, you get paid $150, which you get to keep as well. But if the stock doesn't close above $100 in 30 days, the option expires and you still own your stock. You also get to keep the $150 you collected from selling the call. So you've essentially lowered your cost on your stock by the $1.50 you received. Then you can potentially repeat the process, selling another call with a different expiration date. That's covered calls. Do you need a rest? Refreshing, right? A second way to generate income with options is to use a cash-secured put strategy. When you're looking to buy a stock, you want to get a good deal, just like everyone else. One way to do that is to watch the stock and wait for the price to potentially drop. You can use something called a good till canceled order, which will buy the stock for you if it reaches a limit price you set. And you wait. We don't have time for that. Plus, if you're happy to wait to buy a stock for a lower price, why not be paid to do that? That's what the cash-secured put strategy allows you to do. You take on an obligation to buy a stock if it falls to a lower price, which you choose, before an expiration date, which you also choose. You are paid a premium for taking on that obligation. Say you want to buy shares in Purple Clothing Company. It's trading at $100 a share. You don't want to pay that, but you're willing to pay $95. Instead of waiting and hoping for it to drop to $95, you can sell a 30-day put option with a strike price of $95, collecting a premium, for example, $2 per share. That means if the Purple Clothing Company stock goes below that $95 price in 30 days, you're obligated to buy it and pay $95 per share. In the meantime, you're paid a premium of $200 for taking on that obligation, which you keep regardless of the price of the stock. If the option expires and the stock hasn't dipped below that strike price, you can repeat the process again. If you do this a few times and collect premiums from your put sales, you could choose to use that money towards buying the shares outright or just repeat the process until you eventually get the stock at the price you've chosen. Hopefully that's given you a sense that trading options is an option for you. Obviously, these two income-generating strategies are just a drop in the bucket, but E-Trade has all sorts of tools to help you trade options, like paper trading, where you can try your hand at these strategies before you invest real money. Also, be sure to check out the other resources on the site to build your knowledge and confidence.